Is Amazon.com a buy? It is currently trading at $172.21 a share and is up almost 15% from the start of the year. What we're going to be doing is looking at my automated stock valuation spreadsheet to see if it's a buy using the discounted free cash flow model, the comparable company model, the dividend discount model, and of course the Ben Graham formula for intrinsic value. So let's have a quick look at Amazon. As I said, up 15% from the start of the year, up almost 27% over the last year. And if we go to the 5-year, interestingly only up 90%. We can see if we were to compare it to the S&P 500 over the similar time, yes, it is beating the S&P 500, but it is not beating it by much. If we go year to day, 14.9 compared to 14.3, 27 to 21, and over the last 5 years, 88 to 81%. Obviously, if we go all time, we can see that it's a bit different, but over the last 5 years, this chart is very, very interesting. So let's have a look at my automated stock valuation spreadsheet. If we put the ticker in here, AMZN, what this will do is it will load all the latest company financials and we can have a deeper dive and see if Amazon is a buy or a sell. If you're interested in this, please check out my Patreon. Links are in the description. So it will currently load all the data. $172 a share. 1.8 trillion in market cap, PE of 41, so a little bit on the higher side. Market average has dropped slightly, you can see there, 28.27. Earnings per share of $4.17, a beta of 1.14, which means it's slightly more volatile in the market. And if we do compare to the S&P 500 over that time, you can see the market has kind of gone in a pretty linear line up, whereas Amazon had some highs and lows. So that is quite interesting to see. Analysts do say it's a buy with a target price of around about $220 a share. They do not pay a dividend, so we will not be looking at the dividend discount model, despite what I just said. Let's have a little look at some charts here. So this is the revenue of Amazon going back to 2009. And you can see that revenue is constantly increasing, 5-year compound annual growth rate of around 20%, and they have hit all-time highs of $601.95 billion. So that's good to see. Is profit a similar story? Yes, it is. Oh, wow. Profit, all-time highs again, 44.24 in the trailing 12 months, beating the previous highs of 30 billion. Next, free cash flow, similar story again, all-time highs of 48.34 billion. Shares outstanding, what are they doing? Oh, now we can see that they have actually done some stock splits here, so this doesn't quite display correctly, but you can see they have consistently issued more shares. You can see the number increasing, and even so here, once they've done the split, the number is increasing again. So they are issuing more shares. They're using this to raise capital. Is it a good idea or not? Well, a lot of companies buy back shares, but Amazon are using it hopefully to reinvest in the business. Assets versus liabilities, I imagine these are going to be pretty high. And yes, they are. You can see they're actually separating, as we can see. Liabilities of 132 billion, assets of 172. So let's get into the discounted free cash flow model. This is a way of valuing companies based on their expected future free cash flows. Let's have a look at what it says. So currently, minus $92 a share. That doesn't seem too right, so let's have a look. Okay, this is because the free cash flow rate is wrong. So what we'll do is we'll use the previous year. I'll say about 100% is fair. That brings it to a $61 stock. Now let's have a little deeper look here. Revenue, we're expecting 8%. You can see revenue is down in the trailing 12 months. According to analysts, they're expecting revenues of somewhere in the region of 635 and 700 billion. Growth over the next 5 years, per 30%. So the analysts are being pretty bullish. Let me just remind myself what those numbers were. 635 and 703. So yeah, we're probably in the same line as well. Net income margins, though, these are definitely increasing. Let's put this at the most recent number, which is 7.4%. Still a $90 stock, so not loving it. Now, if they were to grow at 30% for revenue growth rates, but this is massive, you can see it would be a buy at that price. But currently, no, it's about $100 stock on discounted free cash flow. But normally, discounted free cash flow does not like these sort of high value tech stocks. If we look at the free cash flow averages, obviously negative on the most recent year, but the average was 144. So obviously, it's not going to like this. Dividend discount model, we're not going to do because We don't have any. So I'm just quickly jump to the Ben Graham formula for intrinsic value before we do the comparable company. This is a formula created by the godfather of value investing, Ben Graham. What it does is it looks at the earnings per share, the PE of a no growth company, AAA bond yield, and the current AAA corporate bond yield. Current corporate bond yields are pretty high. I think it's still the same. Oh, it's dropped down a little bit, 4.87. That is cool. So this should make it want to be a little bit buy more. So you can see there, they changed in a few dollars. I believe we said Amazon had about a 30% growth rate on what analysts are expecting. Next 5 years, yeah, 30%. Is it going to be a buy? No, but pretty close. $150 a share. So if they were able to grow at about 40%, it would be a buy. Or if we were seeing a decrease in the bond yields, somewhere in the, we wish it was at 0.4%. Yeah, so still high inflationary environments. If we look at the bond yield over time, if we did get back to sort of that historically 3s, 2s, yeah, I mean, if it does get down to 4% again, you can see that is a pretty good buy, 3% or 2% what it was. But yeah, the current rate of 4.8, it is close to being fairly valued, which is good to see. Next, we'll look at the comparable company model. This is a way of valuing companies, looking at similar companies of a similar size or industry. Amazon, well, I mean, I think we'll go with the big guns here. Microsoft, if you put the tickers in, what this will do is it will load all the latest company financial data and we can compare. So if we compare it to the big three of Microsoft, Google, and Apple, we'll be looking at revenue, 5-year growth rate, EBITDA, earnings before taxes, depreciation, and amortization, net income, profit margins, price to sales, price to book, PEG, which is the Peter Lynch's price to earnings growth, EV to revenue, EV to EBITDA, and PE ratio. So just while this is loading, what we'll do is we'll just compare Amazon versus Microsoft, Google, and Apple over this time. Oh, we've already got it here. Apple comparison, Microsoft, and finally, damn you, Google. Goog. So if we're comparing over sort of the 1 year period, you can see they're all pretty close, with Amazon actually being the highest. Year to date, once again, very close again, with Amazon and Apple leading the way. And if we go 5 years, this is where it is very, very different. So obviously Amazon had quite a strong amount of growth up originally, but they've kind of dropped down since then, with Apple, Microsoft, and Google beating them quite handily, with Amazon at the back of the pack. Okay, this is not loading. Let me just re-put in the tickers here. Well, we can compare to Microsoft directly. If we were to compare against Microsoft, you can see this puts it at around about $260 stock if it was valued in the same way that Microsoft was. EV to revenue, it's liking that a lot more. EV to EBITDA, a bit on still liking it, but not as much. And then PE. So these are the two values that I would look at the most. I think Google's giving me some trouble here. Let me just change these tickers around and see if it does load. There you go. That's the problem with their software. Sometimes you just have to turn it off and on, or just make the same exact request again and it'll work. So now we've got all the companies here. You can see it puts it around about $250 stock. PE it doesn't like. It's the highest PE. EV to revenue, EV to EBITDA. EV to revenue will really like because of the high revenues that comes from the e-commerce side, whereas the sort of AWS cloud side, not as high. So that's why they've got much lower profit margins, 8% compared to 30, 26, and 26. Net income still very profitable. Growth rate still growing, and PEG is actually the second lowest, only to Google. So overall, this is looking pretty promising. If we would evaluate it as the other three companies, it would be $250 stock. And if we were to look at here again, with it being at this point, this would actually put it probably in similar growth rates to there. So I think Amazon is being a bit undervalued at the minute, looking at the comparable company model. Right, guys, thanks for watching. Please check out my and what button I pushed there. Please check my Patreon if you're interested in the sheet, and subscribe if you're not already, and I'll catch you guys next time.